Joining me from a secure, undisclosed location, presumably in or around Philadelphia, is Eric Balchunas. He is the ETF czar at Bloomberg. I love your work, sir. You're a 2000 man, to quote Kiss. You've been there since the year 2000, and you rode this incredible ascent of the exchange traded fund revolution. Am I correct?
Yeah, well, I've been at Bloomberg since 2000, and I covered ETFs around 2008, 9-ish.
Now, we are a public radio show, and I'm always exhorted to do some explanation for our listeners to slow down. Because you and I, look, when I hosted Bloomberg Radio, we could have a 144A conversation. We could wonk out AUM, billions, trillions, talk BlackRock, iShares, this, that. But I got to slow down for the public radio listener.
Sure.
Time was, Eric, that, in the era of Gordon Gekko, or well before, the brokerage commissions were huge. If you wanted to buy a fund, an index fund, you had to call a mutual fund or index fund shop and wait until 4:00 for the close, wire them money. We didn't have quotes. We had nothing like the per second, Instagram quote system. But we have, for this century, seen quite a revolution. Since I understand the first ETF came out around 1990 or 1993, you now have how much in exchange traded funds, which if you could explain the difference between an exchange traded fund and a mutual fund.
Yeah. ETFs are just mutual funds with benefits, right? So it's the same concept. You give a firm your money, they invest in a basket of stocks. That way you don't have to worry about a single stock blowing up or something. You're diversified, and they're very cheap. You can get really the entire stock market for 3.03%. People like that. So it's basically like free exposure to everything. I mean, it's in my opinion, we are at an investor utopia right now because of this. And not only that, like you said, you can just get a brokerage account from like Schwab or even like Robinhood, wherever, and you just type in the ticker of the ETF you want. It comes up, you hit buy. And
they don't even charge commissions anymore.
There's not even commissions.
Time was, you'd pay 50,
Yeah.
60, $70.
Yeah.
They'd add basis points to a trade. I cannot underscore for our listeners how much the past 5 to 10, 20 years have revolutionized and democratized investing.
Absolutely. I mean, it's free to trade. The expense ratio, which means the little bit of money that the management company would take out to manage this basket of stocks for you, that's almost insignificant. It's like 3 basis. It's nothing. It's like rounding error. Anyway, why is that good? It means that you get to keep all the returns, and that is crucial because the longer you hold your ETF, let's say it's the S&P 500, and the more years that go by and those returns compound, even a little bit of cost can really take a lot of those returns to the point where after 30, 40 years, the asset manager may have half of your returns. Whereas the ETF, you're going to keep almost every last drop of it. And people like that. And
so say an active manager is charging a half a point or even 3/4 of a point for an old-timey mutual fund. That will significantly deteriorate your long compounded returns. I don't think investors have to understand it is really like a snowflake and a snowball going downhill, accumulating and compounding over time. And you want to leave that alone as much as you can.
Yeah, I equate the expense ratio of ETFs and mutual funds to termites, right? They're gnawing away at your returns. So you want to keep those as small as possible, right? It's just that simple. And compounding to me is an underrated thing in investing, in that in year 10 to 12, you may compound and make more money than you made in your first 8 years combined. That's just how big numbers work. So by the time you get to 10, 12, 15 years, those little fees start to become big dollar numbers. And so the smaller you can keep the termites, the less they can grow too. So
to bring down the entire house.
Yeah, they can take, or half the house. I mean, This is part of what Jack Bogle at Vanguard, one of the charts he used to sell index funds to Americans, because at the time they thought, why do I want to be average? And and he was like, here's why. If you get 8% a year in the index fund, you get $300,000 on a $10,000 investment after 50 years. If you get 6%, that's 1% from the manager and 1% from their trading fees, then you're only going to get like $140,000. So at the end of this long period of investing, again, the asset manager could acquire half just on 1 to 200 basis points of fees. So you got to be real careful. Year to year, it doesn't mean that much. So if you're trading, the expense ratio isn't quite as important. What's more important is the commission, and those are free. But the free commissions are also a double-edged sword because it's free to trade and so easy.
You're going
Some
to trade
people
a
lose their
lot. You're going to
mind,
go in
yeah,
and
and
get
they go
fancy
full
and
like
sliced and diced.
degenerate gambler, and like that's not good. That's usually it's hard to win. Oh, it's just tough. So the winning strategy that if you want to beat all the professionals is buy a really cheap ETF at 3 basis points, probably the
Three
US
basis points is what? How many cents out of every dollar
0.03%. So if you invested $10,000, it's $3.
that they
That's
charge you
all.
annually?
That's it. $3
Yeah,
of yeah, it's like a slice of pizza in Penn Station. It's a pretty good
that's right.
deal.
Yeah.
And you just buy that and wait 40, 50 years, you'll beat everybody. Hedge funds, pension
And
funds.
so this is the biggest paradox, that when people accost me at a cocktail party, and I've had, I used to work at a brokerage firm, I've had institutional experience and this stuff. The fact that simplicity, which has never been so available and so affordable to the individual investor, 8.5 out of 10 times beats the most well-paid managers out there, that you don't have to go out there. You don't have to be funky. You don't have to build this Rube Goldberg contraption, that a simple, say, people might be familiar with the SPDR, the S&P 500 index fund. It owns 500 of the most, diversified, significant, exporting, whatever it is, companies in the United States. They pay some modicum of dividend. You invest in it. There's no commission charge, whether you're buying a SPDR version of it or a Schwab version of it or a Vanguard version of it or a Barclays version of it. It's like buying an avocado at Publix versus Wegmans. It's no different. And you just let it roll.
You do. And what people miss about index funds is when you talk about the S&P 500, that index is always changing. It's an organism. And how does it change? Active management likes some stocks, so they bid the price up. That gives it a bigger market cap, so it gets a higher weighting. And then active hates other stocks, bids those down, and it moves down the index. So the index weighting members are being determined by active. So for example, NVIDIA was like the 300th weighting about 6-7 years ago. It's now like 2 or 3.
It's a
Why?
$4 trillion company.
Yes,
Right.
because active was like, we see good things, and they started buying it. So an index fund really is the best ideas of active without their fees. If
So
you
what
think
it
about
is effectively, for our listeners, it's be the market. Don't try to beat the market.
Yes, and the reason you want to be the market is that the reason the Mag 7 are so big is
The
because,
Magnificent Seven,
yeah,
right?
sorry.
It's Facebook, Meta, Amazon. This is
Yeah,
the hardest part of my job, and actually why I admire what you do so much is
yeah,
I could talk this game,
sure.
but I have to demystify it for our radio listeners.
Yeah, so the
These rock
reason,
star companies now,
yeah,
Amazon, Apple, Meta.
Tesla, Nvidia, Google, like these are like the best of the best, right? And the reason they're the biggest companies in the world largely is because active managers really like them. They looked at their stuff and said, I want to put my money here. And by doing that, the price went up. And if the price goes up, that means their market cap goes up. And if their market cap goes up, that means they get a higher weighting in a market cap weighted index. So that's why, because some people are like, oh, these Magnificent Seven companies are only dominating because index funds. I'm like, not really. Because, if Tesla has a horrible earnings, or Elon does something that drives people crazy, the price, it'll get sold off, the market cap will go down, and it will get a lower weighting in the index. So the good thing about an index fund investors, you get all this plays out, and you don't have to worry about it. Like, let active sort out who should be in the index at what weighting, and they do that. That's their job.
So, but
You just basically
my
buy the
question to
market.
you is, though, when we look at buy the market right now, if I'm
Yeah.
saying the market, the traditional explanation, I know a lot of people quote the Dow 30 on the evening news, the Dow Jones Industrial Average, but really institutional managers, everybody's benchmark is the Standard and Poor's 500 index. And the
Yeah.
problem, without getting into Wonkistan, is it's not a winner takes all, but winner takes lots. So to the point that if you look at the S&P 500 right now, it's so lopsidedly technology because
Yeah.
of Microsoft is worth $4 trillion. NVIDIA is worth $4 trillion. They're $2-3 trillion players that you're effectively buying a tech fund. It is passive, but by dint of the fact that it rewards the biggest winners. So my question to you is, and I'm sure this has kept you up at night, why wouldn't an equal weight S&P 500 be a better mousetrap, where a true democracy, not some electoral college BS, but everybody gets one out of a 500 slice of the S&P 500?
So there's no problem in buying an equal weighted S&P 500. And some people that just fits their brains better. Plus you have disciplined rebalancing. So if one of those stocks starts to get hot, you're going to sell it for a little bit of a profit, and the index will rebalance and buy ones that have been sold off. So you're selling winners and buying losers in that index. That seems logical, and I have nothing against it. It'll probably do pretty good, but here's why the market cap weight typically outperforms
The
it.
traditional S&P
Yes,
500.
is because as stocks go on runs, they tend to last a long time. So you want to really catch that run, and you get that more in a market cap weight. You get more momentum in a market cap weighted index. And the second thing is these Magnificent Seven stocks, in my opinion, they should be called the Magnificent 50, because if you unpack like Google, there's a lot of companies. You forgot Google bought YouTube, right? For like $1 billion, by the way. It's like
For nothing back in the
for
day.
nothing.
Or Microsoft
Everybody's
owns LinkedIn.
Yeah, if you undid YouTube from Google, it would be a massive large cap stock, right? LinkedIn and Microsoft. You Amazon owns Whole Foods. These are like mini Berkshires. So, in my opinion, you shouldn't fear these mega caps as much as you think, because they're really like 50 companies in one. And that's part of why they're so big and popular, is they got a lot going on, and they're smart. They're run well.
Full disclosure, I'm Roben Farzad. It is my joy to finally welcome Eric Balchunas. He is the ETF czar at Bloomberg. And I got to tell you, having been at Bloomberg, they bought my magazine Business Week. This is intended for an institutional audience. People pay dearly for that Bloomberg terminal to get the granularity of analysis that you have. But you are uniquely good, especially on LinkedIn and these other forums, in putting this stuff out in understandable terms. Like you put a chart out recently on LinkedIn, which we said is owned by Microsoft, explaining the explosion of exchange traded fund assets. I mean, this is not something that's going to get reported on the nightly news or be on the front of the Miami Herald, but talk to us about that. This used to be a kind of a backwater. This whole idea of exchange traded funds. I remember when I was in the brokerage industry, oh, there was the Spider, or you could buy a EWJ to buy a Japan thing, but it was overwhelmingly the province of you call the mutual fund company, you get the literature, you wire them money, and you get one price at the close of every day. ETFs in the last 25 years have truly taken over the world, and most recently have accelerated. Explain that.
Yeah, they say as a customer you can get two of these three things: fast, good, cheap. So if something's fast and good, it's probably not cheap. If it's cheap and good, it's probably not fast. You get the idea. You really get all three in ETFs. To me, they remind me of Amazon. It's so easy. There's no friction. Like I said, you roll out of bed, you fire open your brokerage account, and you can own anything. And almost everything is virtually free. I mean, very cheap. And it's very liquid, right? You're going to have it in an instant, and it's good. You buy one ETF, you can own like SPY, you get 500 stocks in one shot. So there's a lot of value there. The other thing is you could buy an index mutual fund like from Vanguard. There's no problem with that. What ETFs did, they brought two things that I think, advanced them beyond the index mutual fund, which is you can trade them during the day. So people like to buy, when you buy something, you want to get it for what it's worth right now. I don't want to wait till 4:00. So the ETFs are just a little more, immediate. The second thing is taxes. In a mutual fund, if people start leaving the fund, the manager has to sell the stocks and you get a capital gains distribution sent to you, even though you're just sitting there. ETFs don't have that because of the way they're create and redeem. They can manage that better. And so you only get taxed when you sell it. And people really like that.
So it is just a smarter mousetrap. It's less stodgy. You don't have to call the 1-800 thing. You don't have to wait till 4:00. It's for better or for worse, it's traded throughout the day. But there are times when crazy things happen, like the flash crash, intraday things, where it would help to get in and out and not be on the phone waiting for a broker. But I even want to underscore in layman's terms, you are so good with this stuff. I know I could pull up this ticker and run it by you. VT, Vanguard Total World Stock ETF. Sure, you're familiar with it. This would have been unthinkable years ago. I looked at okay, this is the Vanguard's. You try to approximate the globe as best as you can. It has more than 9,900 stocks in it. It has a 0.06% expense ratio.
Yeah.
If I wanted to go and, they teach us in business school, the efficient frontier, like what is the best possible thing? If you take one thing away from this interview, right?
Mhm.
In a perfect world, you would want to buy as many assets as you can for as low a price that non-correlate, that things that zig when others zag. And I've said it before, not just
Yeah.
the S&P 500, not just Brazil, not just emerging markets, not just commodities and treasuries and bonds, but I'm even talking Peruvian alpaca fur. I'm talking Haas avocados. I'm talking,
Yeah.
rare earths. Bitcoin has lately become a part of the conversation. Problem is, in reality, for most of human history, that would have been prohibitively expensive. You have to pay a Sherpa. You have to go to markets, some frontier markets trade for 3 hours out of the day. You have to pay currency, transaction fees. The point is, all of that effort would have larded down your returns because friction, cost,
Yeah.
travel.
Yeah.
So, but this is the fact that a person, anybody, can go in and buy a single ETF that aspires to use very liquid publicly traded stocks across the planet to get an approximation of that. That's like a feat of nature. I'm not sure Jack Bogle, one of the founding fathers of Vanguard, would have appreciated that you could do that today. And no one will even charge you a commission for it. And indeed, they'll charge you $6 a year to be in something like this.
It's truly unbelievable. So VT holds 10,000 stocks and it charges 6 bips. If you do the math, it's something like, I don't know, 1,200 stocks per basis point of fee. I mean, that's ridiculous. And you're right. These are the stocks they own are local shares. I think I once looked at the amount of countries. I think there's something like, I want to say 45 or 50 countries in this thing. Honestly, if you hire an advisor, a financial advisor, and they make a portfolio for you, they're largely going to make VT in like using a couple other funds. I will say the reason VT has 50 billion and the S&P 500 ETF from Vanguard has 650 billion, because some people wonder like, why wouldn't everybody just buy VT? But I will say people do like to assemble things the way they want it. So I think the end investor likes to be the decider. Like, okay, I want 50% US, not 60, or I want 80% US. So we do
So
find that
if
like,
they're not charging you anything and all of their ETFs are fractionally cost, you
yes,
can go and mix and match. It's
you can
like
go
you're
mix and
you're
match for it.
you're
It's
you're
yes,
you're at the Mongolian barbecue. You could put anything
yes,
on your plate in any proportion that you want.
yes.
Have we already exhausted 8 metaphors here, my man?
I think
This is the difficulty
we're
of doing
mixing
what
a
we're
lot of
doing.
metaphors here.
Yo, if we were on Bloomberg Radio, you'd have to be throwing bips, AUM, but here I gotta like slow it
I
down,
know.
cowboy. You're talking
Bips is
bips.
such. I got to stop myself because I remember not knowing that. But all the basis point is it's 0.01%. So if I say 3 bips, that's 0.03% of fee. So a bip is tiny. It's almost like a microsecond in terms of fees. You know, it's like the equivalent of. But anyway,
What is the motive? What is the motivation for these companies, such as iShares or BlackRock? Because it's like they used to ask, what is the motivation for Walmart to race to the bottom on prices? Is it all a volume play? Now we know Vanguard is really unique. I'm an active Vanguarder. I interviewed Jack Bogle. He was he was a mentor of mine after college, right? When I saw him speak, and I would meet him at the Princeton Club, and he would explain the simplicity and push back against all of the new shibboleths and
yeah.
whatnot. Um, but I'd ask myself, what are you guys in it for? Because you keep sending me emails that you're lowering these basis points. Effectively, the more business you get, you're just bringing prices down. You're not a charity.
Yeah. So Jack Bogle was an anomaly in physics. He built the largest asset manager ever in Vanguard. It has almost 30% market share of funds in the US. That's double the old high water mark of Fidelity. And he himself wouldn't be on the top 2,000 people in like richest in Wall Street. And you got to give that guy credit because when he set up Vanguard, he wrote it, he structured the company so the investors owned it. So he wrote away billions in possible profit for himself. And that is a crazy move. I wrote a book about him called The Bogle Effect because I was like, that
Yeah.
is almost insane. Like nobody purposely gives up a lot of
But he
money.
would
Like,
say, like, I remember, and he was really frail. He had a heart transplant. He'd had difficulty opening a ketchup bottle with his fingers. And he would just say it in his final years. What am I supposed to do? Eat more?
yeah,
Like, what do you want me to do? Eat more? Like, this is a guy, he wouldn't even take the
yeah,
Acela between Philly and DC. He would take the Metro liner. And that was part of
yeah,
his brand.
it was.
And
So,
it's really Vanguard's brand. And
yeah,
honestly,
yeah,
it caught on with Schwab. It caught on all of these other guys kicking or screaming, had to race prices down to the bottom.
yeah. That's why I called the Vanguard effect. I mean, you would think the Amazon effect is similar. It caused a lot of retail to come down. Bogle's World War II generation mindset, he grew up during the Depression. he's like Buffett in that way. You know, Buffett still drinks cherry cokes and go to McDonald's, lives in the same house. There's certain dudes from that generation that just don't like care about money that much. But that's what I was saying. I was like, this guy was almost miscast as a Wall Street powerhouse guy. So it's an interesting character that he has that World War II generation frugal thing, but he applied it to Wall Street and everybody benefits because Vanguard forced everyone else to get cheap because once you do that, you get flows. And so Vanguard is largely the governing force of the whole apparatus at this point.
Isn't that crazy?
It is
One
crazy.
company
Yeah.
was started with $11 million in assets, let's say 50 years ago in 75. But by the way, that's when brokerage fees were, I think, regulated. They were expensive.
Yeah, they're like
The
50
cost
bucks.
and the stock market was a backwater. You know, the Dow, it was the death of equities period. Inflation was bad. It was by no means democratized.
Yeah, I mean,
Um, for
I
him, it was a lot of people thought it was this hopeless quixotic journey of his.
I compared him in the book to being part Steve Jobs in that he wasn't just an ideologue. He made products you could use. That's a whole different skill set. And he managed the company of like all these people. But also Martin Luther, not Martin Luther King Jr., but Martin Luther.
And the Reformation.
Yeah, it's like he put that notice on the Wall Street door and said, "I'm coming here to. You guys are all screwed up. Lower your fees." And Martin Luther preached inside the church that the church is like corrupt. And Bogle would go to Morningstar conferences and say, "This whole industry is corrupt. You got to lower your fees." So, and he even sparked a religion. There's a Bogleheads like religion where they all meet up all over
He's
the
Saint
world.
Bogle. I've seen the candles, where you light a candle to
Yeah.
Jack Bogle.
So there's a Steve Jobs. I did it in product world, and then there's this religious aspect to what he did. If it weren't funds, which is as interesting to C-SPAN as most people, he would be like really celebrated. So I wrote that book because I'm like, if this were any other industry, everybody would know this guy's name.
Wow. Full disclosure, I'm Roben Farzad. Again, our guest is Eric Balchunas. He is the head of ETFs coverage at Bloomberg, I guess in Bloomberg Industries. You're at that curious nexus of, like a B2B person, but you're also front-facing in media circles. I wanted to get in this conversation a bit. The Bloomberg terminal I miss, right? I haven't had access to it for 10 years. When I was in the industry, they gave it to us. Bloomberg would always give a login to Business Week and the New York Times and other places that I've worked. We're at the point of artificial intelligence. I'm sure you're hearing about this enough, where I can ask Chat GPT anything about any ETF and do a comparison, and maybe with a couple of double checks, make sure that it is fairly okay. It used to be the province of Bloomberg or Yahoo Finance or comparing these things. How much has that changed your life, and how much pressure is there to incorporate that functionality into the Bloomberg terminal, which, again, for those of you out there, Bloomberg Terminal trades, you could track Italian rabbit meat futures. You can clearly see the number of oil tankers in the Gulf, how many of them are full of oil, not full of oil, diesel fuel and everything. The granularity is crazy. But as you know, as evidenced by NVIDIA and Microsoft and the others, we just hit a tipping point with kind of what AI does in terms of the hunger for research and search and power.
Yeah, no, I just saw Microsoft put writers as one of the top 10 industries that could be replaced by AI. So we use it. We use it sometimes to do some filler content. We also use it just for ideas like, hey, I'm writing this note about JPM. And sometimes AI will spit out something you didn't think about. So it's like a helper. But I am of the opinion that, the human, your voice, everybody has a voice. And if you're a writer and you find your voice, when you write in your voice and you have something interesting to say, it somehow comes through the screen as like fresh fish, whereas AI comes off a little dead.
And you see the dead eye look in the eye, and you
Yes.
avoid buying
So
it.
when the Hollywood writers went on strike, there was this picture of this woman who had a sign that said Chat GPT never had childhood trauma. And
Which is the best source of comedy ever, right?
Is that the great? Like that's it. Like because it can never truly be my. We use mixed metaphors all over this. What we just did, you can't replicate. We are two human beings with bringing all of our experience, wealth, knowledge, and humanity into this conversation. But at the same time, prepping for this interview, AI could have helped a lot. Like there's a lot of things AI can help with, but I just don't see it replacing what we do completely. And in a Bloomberg News story now, at the top it says AI summary and it gives you 3 points, which I know not every writer is totally thrilled about because some people just read that instead of just going to read the article. But this is what people want. And I think AI is here to stay. So we're definitely trying to incorporate it as best we can. But I haven't seen any like really anything alarming where it's like, okay, we're going to be replaced or anything. It's more of just like, how can we use it to make sure we're adapting to all the tools we have?
Full disclosure, stay with us. Full Disclosure podcast to NPR, Spotify, Apple's, gosh, the whole works. I mean, we're even on YouTube for whoever wants to watch that. We are on LinkedIn. The handle is Roben Farzad, Full Disclosure, however you want to find me. And my DMs are always open. Shout out to our radio listeners on KPPQ out in Ventura, California. We are on WPVM in Asheville, North Carolina. Gorgeous this time of year. And of course, WVTF Radio IQ across the great Commonwealth. Holler if you too would like us on your air. My DMs are always open. If you're just joining us, my esteemed guest, Eric Balchunas, he is the head of ETFs coverage at Bloomberg. He's a hybrid kind of analyst, guru, cheerleader, spokesperson, savant, journal. But you actually, sir, you're very easy on the eyes. You should be. We always say this. You look like a kind of a Dawson's Creek chill dad, right? And part of me worries that this is all wasted in service of ETFs coverage. I have the face for radio, but you, sir, should be out there.
Well, I get Peter Brady sometimes.
Peter Brady, that's
yeah,
right.
But I appreciate that. But to be fair, I do a TV show every Monday at noon on Bloomberg TV, which is free, by the way. ETF IQ is the show. It's only half an hour. And then I do some events. So I do get myself out there. But I'd say 80% of my life is writing, analyzing, and looking at data. And and I have a podcast too, which doesn't require me to be on camera. But so I try to do it all. I feel like in this industry, like if you're an analyst now, it's not enough just to write your content and expect it to just like go find an audience. You kind of have to be like a multi-figured force. You have to have takes. I really look at the sports industry and the political industry. Like you kind of have to, I hate to say, you have to have a little Stephen A. Smith in you. You have to be able to be out there, do all kinds of mediums, hustle, and you never know which hand is going to hit the right person at the right time. And so I just try to, make sure that we are being, and again, that's also non-AIable. Like AI is going to have a tough time doing all of that. And so that's part of why we do all these mediums and keep ourselves really as everywhere we can go, because content is like coming at everybody like 100 miles an hour. It's like a waterfall. And like it's tough to stay out there. So you have to just be consistent, be diverse, and have really interesting opinions.
And please stick to the rivers and the lakes that you're used to.
Yes. Don't blow yourself up. Don't say, yeah, I do. I really pride myself in staying in my ETF lane. It can be tough on Twitter with politics and stuff. I will occasionally talk about sports or movies, but I try to keep it out of like radioactive issues.
Eric, when people accost you at a cookout or outside an Eagles game, or some of those violent meatheads or whatever they are, and they have a couple of brewskis. I don't even know what they drink out there. What is
Yingling.
that? Yingling, of course.
Yeah.
They ask you in a perfectly sober moment, like, how much diversification do I need in ETFs? We have all this stuff out there, but what do I really need? Because I've even spoken back in the day, Jack Bogle told you don't need an international exposure. The S&P 500 does it for you. You have enough U.S. companies, whether they're Coca-Cola or John Deere or Intel, I don't even know, who else, who are exporting a significant part of their wares abroad. You saw how much NVIDIA rallied recently on this relief with sales to China. And yet there are others out there, who believe you need to go into that frontier. You need to have emerging market companies. The United States is not the only game in town. In fact, the United States was an emerging market 150 years ago. But then you and I know this. You can go out into there are people who are like small cap gold people. They're the dimensional people who you should be in factor investing. Not only should you not be lopsided in the S&P 500, you need to go into other things, small value, other quadrants. I always wanted to ask you, and to the extent, what do you think is sufficient? What do you do?
Yeah, it depends on the person. Like if you're the kind of person who just like really has a tough time with volatility, like if your portfolio is down 15% in a year, are you going to lose your marbles? Or can you handle that? Because the reason Bogle, you don't really need international because it's a global world anyway. And the US is so powerful part of that that Bogle was like, just buy the US. Also, you don't have to do currency conversions. When you go
Okay, but you
international,
remember the first 10 years of this century, the US did nothing, bupkis, and international had a torrid 10 years.
agreed. The US was flat from 2000 to 2010. And that's the thing. If you're a long term investor, though, it over the past 30 years, though, international destroys it. But that's what I'm saying. If you can handle those kind of periods, then you can just do US. The reason to do international, in my opinion, is that you have something out, maybe outperforming when your US is down. And that makes people feel better. So I think it
So
can bring the overall volatility of the portfolio
the
down. And some
worm
people
has
don't need that.
turned the worm has turned since the financial crisis. US has been gangbusters, mid-teens average annual return led by these big tech and
Yeah.
magnificent seven stocks. International has done nothing pretty much for 15 years.
Yeah.
And so at the end of the day, I'm thinking in practicality, how many people throw in the towel? How many people say, I don't want to wait. I don't want to wait for long cycles. I just want something simple, something that will mean revert. But of
Yeah.
course, there were times like 2008 where the US will absolutely plunge.
Yeah.
There are times like even that near death experience in 87, which if you look at a long chart is nothing now. If you
Yeah.
look at 1998, it's nothing now.
Yeah.
But you lose a lot of stomach lining in the process.
Yeah. Look, I mean, a lot of people have insurance for their car or their life. A portfolio has insurance by diversification. So you can have treasury bonds in there. Even Warren Buffett, who's the biggest bull, in his will, he told his wife that put all of my money in a Vanguard index fund, S&P 500, but 10% in cash treasuries, like short-term T-bills. So even he wanted, some buffer in there. But for the most part, I think most people a diversified portfolio of stocks, bonds, little international. That's how an advisor would build a typical portfolio. But Bogle, again, he's a unique character, and he was all in, and was like, your holding period is forever until you really need it at the end. So that means 10 years isn't a big deal. You can
But it
stomach
is
that.
paradoxical, isn't it? In that the entire world, you have China taking a record number of people out of poverty. You have places like South Korea, which are still considered emerging markets, but we buy their cars. Hyundai is no longer a joke.
Yeah.
Samsung is not a joke product. These countries that have come online that they were nowhere to be found
Yeah.
50 years ago. Is it a little, the U.S. exceptionalism is a bit much to say, okay, great for you, but I'm sticking with the S&P 500.
Yeah, look, I do think the U.S. is an exceptional place. Like, we are just so good at capitalism. That said, there are definitely good stories out there. So I was, for my last book, I interviewed an advisor at Wealthfront, and they're like, look, if a company's coming out of China that's doing something, I'd want to own it. I want to own everything. So like VT is a good a thing for someone who just doesn't ever want to miss out, because with VT you're going to own all those companies, and you're going to own, if you hear something about China healthcare, you probably own it. You know what I mean? So I think for what you're saying, a large global diversified portfolio makes sense. That said, I do think the US is special at just, we're innovative, we're a melting pot, our system is designed to take big risks. We are told to take risks as kids. Like, the whole culture is set up to take risks, work hard, and so we've produced these great companies. So I do think that there is some exceptionalism regardless of the environment, and that's what I think Buffett or Bogle would also agree with. But to your point, there is good things happening elsewhere, and so owning those companies makes sense also. So I think you want to own. The one thing about small caps, just real quick,
Smaller
company,
capitalization
yeah,
companies, right?
small caps, there is a movement to like maybe not own them these days, because it used to be a company IPO'd there. So you'd catch these like up and comers, almost like a farm league in baseball. But a lot of times the IPOs now, they wait till they're large and they come in as large. And so the farm system of small caps is much weaker. It becomes like more of a junk bin for large caps that couldn't make it. So that's why small caps haven't ever had that run. And we're trying to figure out whether it's permanent because of this IPO issue. That's one reason also people lean to large caps. But again, if you're a person who doesn't want to miss out, it's better just to sort of own it all through a VT type fund than just own US large.
So, Eric, passivity aside, you've also underscored how much of a movement there have been in active ETFs where you bring human interest back into it. So, to take your small cap example, by using human eyes and analytics and other things, and you can come in and separate the baby from the bathwater, the true babies, the true, the bench warmers from the whatever. Does that then start reinventing the whole thing that was problematic to begin with, which was the higher cost active management mutual fund? Are we back to that?
No, because what's happened is if you want to sell your active fund in the ETF market, you got to get cheap because ETF investors now demand low cost. So what's happened over the past 5, 7 years, Capital Group, Fidelity, JP Morgan, they've come into the ETF space and they've really lowered fees. So you can get a good active manager now for 10 to 35 basis points, right? So that's pretty cheap. And people are starting to respond to that because remember, the lower your fees are, the more you get to keep and the more that manager can possibly outperform because it's less hurdle to overcome. And so that's finally moving the needle on active. And so in a way, again, always think the ETF market isn't just the ETF market. It's a gauntlet or crucible that the whole Wall Street apparatus has to eventually go through in order to adjust itself to the Bogle effect. And so as active is, because thematic has done it, smart beta has done it, like factor investing's done it. Active was kind of the last holdout. They're like, no, we're too smart. We deserve 90 basis points, yada, yada. But they finally, a couple of them went in, lowered their fee to 30, 20, 10 basis points, and they started seeing flows. And so more followed. And so what you're going to have is, again, that's why Bogle, again, deserves so much credit for this. You have these active managers actually playing ball now. Now, they're not going to 3 basis points. They do think their active special sauce is worth 20. But a lot of people are like, yeah, okay, fine, it's worth 20. It wasn't worth 90, but I'll pay you 20 for it because I can get the index for free. So if you're going to give me like most of the index, but with some tweaks around the edges, only charge me for that tweaking. Don't charge me for the index. So people have adjusted their fees to account the fact that the market is now free to get exposure to, and that's working. So active, and they've also gotten clever. Like active now puts out thematic ETFs. So it's like, oh, hey, you want to invest just in AI. And so active has evolved around the Bogle effect, and that's how they're going to make it. But that old school active of like a 1% mutual fund that mostly owns the S&P 500 that you probably bought in the 90s, that is the endangered species here. That's probably going to go away.
Well, I have to ask you also about credit. If I'm to understand that the fixed income market is significantly larger than the equity markets, right? There you're talking about the global credit markets. And I don't know if you've ever been to the Treasury Direct website. It's awful. The United States Treasury built a user interface for us to go in and buy bonds and notes directly. It's absolutely terrible.
Yeah.
I do believe it was designed by East Germany in 1972. But which has me wondering, there are fixed income products, ETFs especially, available super liquid on the New York Stock Exchange and others. When are you going to see more bonds gravitate toward this? And that's got to be a killer app. I mean, if I'm not just interested in buying Verizon stock or Verizon in an exchange traded fund, but I want to buy Verizon corporate paper, credit going out several years that yields this much. The user interface of these fund groups of Vanguard, of Schwab and everybody is amazing. It seems like that's something that can be bolted in. I mean, and we'll get to Bitcoin and commodities too, because clearly you get asked about this left and right. It's not just a universe for stocks.
Sure. I mean, you could argue the bond market was the most ETFable because bonds don't even trade like stocks. There's no bond exchange. So bonds, I mean, ETFs make bonds trade like stocks. So now you can own a bunch of treasury bonds, like TLT is the ticker of the 20-year treasury ETF, 20 treasury bonds, and you just type in TLT and it has a ticker and it fits into your other ETFs. So it's great.
I can't understand that thing. And it's so volatile. It's crazy. It trades like a kind of a
TLT
junk
is not the
bond
greatest
thing.
example because long-dated treasuries are they can be almost a place for traders to play.
Yeah.
But like something like AGG is the aggregate bond, owns like a bunch of treasuries, mortgages, corporates.
AGG is like the S&P 500
Yes.
for the bond market.
Yes.
Yeah.
That said, I personally like IUSB, which is the universal, which has a little high yield international. So even the indexes have been evolving over the years. But I'd say bond ETFs I think they're like 25% of all the ETF assets now. They're growing pretty quickly. And one thing about bonds, though, there's a debate in the industry about bond, like the aggregate bond index, that AGG I just mentioned. It's not barely kept up with inflation. Bonds haven't done that well for you over time, but they do still have a low correlation to stocks, even inverse, so they can buffer downturns. But certainly bonds having a there's not. I mean, stocks have just outshone them so much. But ultimately, I'm not going to mess with something that has like 150-year performance. It's doing
Yeah,
pretty
for
good.
the longest time,
Yeah.
we're talking about the 30-year bull market in bonds that started in
Yeah.
the early 80s. And it was a disaster starting in 2022, and people did not um,
And
uh,
but by the way,
acclimate to life and inflation well enough.
one little anecdote, you said the treasury site is really hard to use. There's actually an ETF that just invests in one treasury bond. That's how annoying that site is, that they're actually making an ETF that just goes out and buys one bond for you.
No, really, that
Yeah.
exists.
Yeah. That
So it's
exists.
so they're down there. They're reducing the friction. They're adding
Yes.
some basis pointage to it,
Yeah. Just to
right?
buy one. It's not even a basket. It's one. It's called, one of them is U2, not the
So
band.
why can't we have
U2WO.
that for every treasury security?
Well,
I
they
mean, this
are.
is what I don't understand.
They've got one for every, like they got a 2 year, a 5 year, a 10 year. So whatever on the curve you want to go, it'll just go buy one treasury for you.
So this is sucking in everything in the
Yes.
world, right?
Yeah,
I
because
mean,
look,
as much as the
people are
broker's
lazy.
desk, as much as the bond desk wants you calling them
Yes.
for an illiquid bid ask and giving points to the brokerage firm, this is kind of inexorably, unavoidably taking everything else in.
Yeah. Look, if you can make something even a little more convenient, in any business, you're going to get customers, man. I mean, it's just people are lazy. They like things easy. And most people don't want to think about any of this stuff. I'm into it and you're into it, but like most people, it's like going to the car mechanic. I don't know any of this stuff. Like, just please let me trust you, make it easy, make it as cheap as possible. And then I can move my brain on to stuff I want to think about. And so ETFs are kind of like really, really like hitting the easy button for a lot of people. And that's why they sell. I mean, it's not that indifferent from other businesses.
Eric Balchunas, I exhort you to go to a Persian wedding in Los Angeles where somebody finds out who you are, you're bound to get accosted by some Iranian uncle or cousin type figure that you've never heard of, who's going to try to sell you on the merits of gold, silver, oil, and commodities.
Yeah.
Now, we did a big Bloomberg Business Week cover back in the day, don't buy gold ETFs. That gold might make sense as a hedge atavistically, ancestrally. We all know it's valuable. There's only so much of it that was ever mined, that there is a universal humanity rush to safety, whether you're talking about people in India, in the United States, Iranians, Canadians, Mexicans, they're going to go for gold, miners. But people have always told me, if you're going to participate in this, it's inefficient to buy a commodity through an ETF. There are always these things going on between expiration and others that end up larding you up with so much in expenses and costs that it diminishes the point. Now, meanwhile, it's not practical for me to go and buy 500 barrels of oil and put them in a warehouse in LAX, or to buy all this gold and to warehouse it and to get it checked, or to go and buy wheat or coffee.
Yeah.
Correct. So some things are not amenable to the ETF securitization.
So ETFs track all that stuff. But to your point, if it's commodities that divide into two parts, ones you can hold physically, like gold, where they just go buy bars of gold and put it in a vault. That's great. GLD, IAU are two gold tickers. They trade great. There's no funky business. I endorse those. But for stuff where it's commodities that like would be hard to store in your backyard or in your house, like oil or corn, it would smell, go bad. They use futures. And the futures, you have to keep rolling them so that you never get delivered the commodity. And there's cost in rolling those futures. And that's the funky business that make those tricky. So I would say for gold, silver, Bitcoin, and anything like that, the ETF's great. I think for oil and corn and anyone that uses futures, I would probably stay away from it unless you're a professional, because it has a third variable that's called rolling futures, and people can be surprised. Like, you could buy USO, the oil ETF, oil goes up 40%, but the roll costs were 25%, so you only got 15% of the 40, and people are like,
Yeah, and so
what?
people who have bought these
Yeah.
ETFs they've emailed me in the past like, what the heck?
Yeah.
I see
So
the price of crude Brent go up by 40%. Why am I only seeing half of that?
we have a system that's like movie ratings for ETFs, and all of the commodity ETFs that hold futures are rated R.
Rated R.
Ones
Not
that hold,
NC-17?
there are some NC-17 ETFs that would do like, for example, 2X VIX futures that's in an ETN wrapper. I mean, there's some funky whack stuff.
You could see there are some Wall Street bros popping 12 zins 12 zins, I'm a zinfluencer and buying these reverse inverse ETFs with leverage money. They tell us stay the heck
Yeah.
away from that. But if you go out there into the
Yeah.
exotic land of ETFs, you could
Yeah.
find some real Wookie bar stuff.
Yeah. There's leverage ETFs. Basically anything rated R or leverage. Just be careful with it. I would just treat it like a chainsaw. If you kind of figure out what you're doing, it can do something quick, but you can hurt yourself. So, but I'd say 95% of the assets in ETFs are in PG 13 or PG ETFs. So we do discuss these wild ones, but they're pretty small. They're usually for like degenerate traders.
Why do they always say, I'm watching Casino or Goodfellas? Why is a gambler or a trader always a degenerate? Can you be a can you be
I'll tell you why.
you always have
Like,
to it's like a golf ball sized hail. They say degenerate gambler. Why is it axiomatic?
like, like, there's an ETF that's 2x Nvidia. It just
There's one
gives you,
ETF so that does double the
yeah,
return of
double Nvidia.
Nvidia
That's
for
all it
better or for
is.
worse every day.
$6 billion. It was a real hit. And like, you ask yourself, well, isn't Nvidia enough? Well, no, I want 2x Nvidia. That's a degenerate thought,
Well, you
right?
have Monster Beverage, you
Yeah,
have Celsius, you have all these
yeah,
different tiers in the 7-Eleven fridge. This is the problem. It starts to get into really exotic stuff where they always say in the Series 7 and 63, know your client, know what you're buying. And I'm not
yes,
always convinced that people necessarily know what's out there, especially with commodity and leveraged ETFs. But in the few minutes we have left, Eric, I know you have a hard out, and so do we. Um, where is really AI going to take this? That AI hive mind, that HAL, is that going to be able to crunch? I have to imagine in short order, you're going to see AI strategy led ETFs where some sort of mind that ranks at the top of your Eric, Rotten Tomatoes index, rated R, rated PG, rated all that is going to, you can track some company's black box
yeah.
that has, terabits and terabits and terabits of data that's fed into that large language model. And you're just buying the alpha of that black box. Is that crazy? Is that Kubrick or is that already here?
It's already here, and it doesn't do well. There's an ETF that was based on IBM's Watson, and it came out like 6 years ago, and it's like we can do the work of like 50 analysts over 10 years in like 1 minute. And it was like, okay, great. And they really sold it. And so this was the judge of AI, and it only gave you half the returns of the S&P 500. It traded a lot, had a lot of turnover, but it just, I don't know, it didn't outperform. So AI managers or AI funds are going to have the same problems as active managers. It's hard, especially the more you cost, the more you charge, and the more you trade. And so these AI funds are going to not be able to do anything, they're not going to be able to avoid the issues that human managers had either. So I'm pretty bearish on AI funds. I'm slightly more bullish on ETFs that invest in AI stocks, like Chat and these other ETFs that go out and they say, this is a big theme. Let's buy some of the stocks that are going to benefit from the AI revolution. That said, if you own the S&P 500 and you own those Mag 7 names,
Yeah, which gets us back to the Bogle
you're probably
conversation in
getting
the end.
that anyway. So you almost don't even need any of it.
Do we need commodity ETFs? Do we need an oil ETF? Do we need something that tracks two times of this to this? At some
No,
point, you get too pretty and you
no.
get far away from this really great long term return. Again, markets have been unusually good for the past 15 years. And in the 10 years prior to that, they did nothing. So as much as people forget, I did a Business Week cover, I think it was in 2005 or 2006, that said blue chip blues. Why are the biggest companies in America such a disappointment? They were doing nothing forever. Like we just, today, I'm going to go on NPR and talk about Microsoft crossing a $4 trillion market cap. Microsoft in the early aughts could not give people money, could not buy back enough
Yeah.
stock for anybody to own their stock. And I think that just speaks to the difficulty of patience. And as you know, people are always chasing these trends. In your world, if an ETF is super hot and doing super well, you're going to see JP Morgan and the others come up with a copycat thing to capture the flows coming to it. And meanwhile, the theme might move to something else the following year.
Yeah, themes are like flavors of the month, and they can help. You can invest in like narratives and news cycles and stuff like that. It's EVs or AI because they go a little further than the sectors go, and so I'm okay with them. I think they're used in small increments. We think the modern portfolio is 85% low cost stocks and bonds, probably in index funds, and then 10 to 15% is you customizing it with either some hot sauce, some speculative stuff, maybe some income. And themes fit in that smaller hot sauce bucket, and they're fine, but you wouldn't want to put your whole life savings in a thematic ETF. I think most people, and the assets are, you can tell from the assets they're only mildly popular. But the Microsoft issue is also interesting. One thing about those Mag 7, which I say are Mag 50, they also have a lot of cash. Back in the day, they just didn't have as much cash. They were true growth. Now they have so much cash on hand, they can survive a lot, and that gives them a little more durability than the growth stocks they were in the 90s.
Sir, you have a lot of durability. You've been doing this at Bloomberg now for what, almost 25 years, man?
I know.
You are wonderful to do this. And I want to thank everybody. Eric Balchunas, just look him up. He's a major draw. Like I said, he normally does arenas like 50, 60,000 people. And this is like the equivalent of doing the state fair with sticks in Kansas and corn dogs. So I'm grateful to you, for our friendship and being able to do this show and explain it for an NPR listenership. Thank you, sir.
Oh, it's been my pleasure. It's always fun to talk to you.
Come back anytime.